strategy of owning a stock, buying a put, and selling a call, there's a name for it. It is referred to as a collar trade. This collar trade strategy, and on the slide, you'll see the name Mark Cuban. He sold his company on a stock swap with Yahoo right before the dot-com bubble burst. And when people asked him, in fact, there was an interview, you can Google it. When they asked him, how come you didn't lose all your money? He said, somebody, and I've done lectures with Mark, and I was the one that told him, this happened before he and I met. He said, somebody told me about this thing called a collar trade where I could protect my downside. If it wasn't for that strategy, you wouldn't know the name Mark Cuban. You'd have never owned the Dallas Mavericks, wouldn't have been on Shark Tank. One strategy can change your entire future. Last break of class. You got 15 minutes. I've saved my favorite strategy and my go-to strategy for last. See you in 15. All right, welcome back. So I wanted to make sure that we had sufficient time to cover one of my very favorite strategies. Everything is situational, right? Sometimes straight calls, straight puts, covered calls. But if somebody said you could only do one kind of a trade, one trade structure for the rest of your life, what would it be? It would be this one. And let me just give you kind of the foundation for it. When you buy a call option, there are 5 things that the price of that underlying stock could do. Or same would be true of a put option. Stock could go way up, go up a little, go sideways, go down a little, go down a lot. So out of those 5, if it's call option, on how many do we make money? Stock goes up a lot. Yep. Stock goes up a little. Yep. Stock goes sideways. Nope. You don't make any money. Goes down a little. Don't make money. Goes down a lot. You don't make money. So you make money in 2 out of 5 scenarios. If you have a put option, if the stock goes down a lot, you make money. Stock goes down a little, you make money. Stock goes sideways, you lose money because of theta, time decay. Stock goes up a little or up a lot. So in both, whether you have a call or a put, there are 5 possible outcomes. You lose money in 3, which means your probability of making a profit is 40%. Having said that, the upside is greater than the downside, and you can skew those averages by being good at forecasting what a stock is going to do in the future. But would you like to have a way to make a solid, consistent return with a higher probability? I'm sure the answer for all of you would be, well, yeah. Welcome to the world of spread trading. So conceptually, with a spread trade, we are simultaneously buying an option and selling an option against the same underlying stock. The idea is the option we're selling is helping to pay for the option that we're buying. It reduces the amount of money that it takes to put on a trade. And it will allow you to be able to place trades on very expensive stocks where maybe a straight call or a straight put would be too expensive for your trading account. To do a spread trade, you need to have at least $2,000 in your brokerage account. Otherwise, they won't accept the trade, but $2,000 is not a whole lot of money. I will tell you that this is probably the most sophisticated of the strategies. You know, the leap with the covered call against, it was pretty sophisticated. This is probably the most sophisticated. It'll take you a while to learn it. If you're new, there's almost zero chance you're going to walk away going, I'm going to go put spread trades on Monday. I'll give you some examples where you could do those in your virtual account. Those of you that are going to be working with us for the next year, you're going to master this strategy. As I do a description of it, especially if you're not 100% paying attention, and even if you are, there's a chance you could get lost during the description. But don't get discouraged. Where it will come together is when I actually show you the trade. Then it'll start to get clear. Whole lot of buildup, right? For this strategy. Let's get to it. So when we're doing either call spreads or put spreads, the key is identifying stocks that have either a strong level of support for call spreads or resistance for put spreads. Now, in this market, with this upward catalyst from the rate cut, et cetera, my focus when I was making a note of prospective call spreads was only stocks that had strong support. I'm not doing any put spreads in this market. I always have call spreads on, however. So this is kind of what it looks like, okay? So this is the part where I might lose you a little bit, but you'll only be lost temporarily. I promise to grab your hand and take you home. So I mentioned to you that we simultaneously buy and sell. Let me add to that. Both of the options that we buy and sell at the time we put the trade on would be in the money. Therefore, by definition, you know that the price of the stock, if these are both in the money, you have a 105 strike and a one, you know then that the price of the stock is above 105. In this kind of an example with these numbers, having done hundreds of these trades, let's assume that the price of the underlying stock is $110 a share. Now, what we're doing in theory is we're going to look at a chart and we're asking this question. Where do I think the price of this stock won't fall below? And in this case, we're assuming, because maybe there's a really nice level of support there, or the 50-day moving average sits there, we're assuming that the stock will not fall between when we put the trade on and when this trade expires, typically 2 to 3 weeks out in the future, that it won't fall below $105 a share. So we're assuming the current price of the stock is 110, right? So if the stock during the holding period of this trade goes up to 120, we make a maximum profit. If the stock doesn't move at all, we make maximum profit. If the stock fell $5 a share down to 105, we make a maximum profit. By the way, what other trade can you think of where if the stock goes up, sideways, or even down a little bit, that you make money? Well, how do you lose money? If the price of the stock falls below 105. So our risk comes from a stock that falls below our short strike price. So from a practical standpoint, let me tell you what we would do. If this stock started coming down and it got to 105, we would just close out the trade. How would we close out the trade? We would reverse the way that we put the trade on. So if we're short this 105 strike call, we would buy that back. We're long this 100 strike call, we would sell that as part of one trade. Again, it's going to take a little while to learn. So in this example, we are selling a 105 strike call and we're collecting $1 a share. We are buying the 100 strike call and we're paying $5 a share. So if we pay $5 a share, we collect $1 a share. What is our net cost? $4 a share. Now, if both of these options finish in the money, that means the stock's at 105 or above, then automatically we would be assigned, we'd be buying the stock for 100. This party would be selling it or buying it from us at 105. So the difference is $5 a share. We paid $4 to get into the trade. So if you make 5 and you've invested 4, what is your profit? $1. What is your risk? The maximum you could lose is what you paid, $4. So we're making $1 on a $4 investment. That is a rate of return of 25% with a max risk in this example of $4. And these numbers are really close, as you're going to see, to what we'll find in the real world. You know, in most of our trades, we're targeting a profit of somewhere in the neighborhood of 20% for 3 weeks. I'll come back to that. On the put side, instead of betting where we think the price of the stock won't drop, on the put side, we're betting where the price of the stock won't go up. So we buy a higher strike put, we short a lower strike put. Both of these options would be in the money. This is a separate trade, by the way. So the first one is a bet the stock's not going to fall below 105. This one would be a bet price of the stock is not going to go above 100. So maybe when we put the trade on, the stock's at 95 and not showing signs of going higher. Okay. And as long as at expiration, the stock doesn't go above 100, I've used the same numbers, you would have exactly the same rate of return. Our focus in these examples I'm going to give you are going to be on the call side. Plus, the call side, candidly, is easier to understand. And that's where you would want to begin in this market anyway. So your max risk is your debit. You take, what did I pay for the long option? What did I collect from the short option? And you net those together. Your max profit is the difference between the two strikes, the spread between those strikes, minus the debit. So we're looking for stocks that have strong levels of support for call spreads, resistance for put spreads. Our targeted profit is 1% per day. That's our targeted profit. We generally go out 2 to 4 weeks. And you keep an eye on that short option. If the stock moves against us and we get down to that short strike price, we're going to close out the trade. Otherwise, if it moves below both of those strikes, that's where you take a maximum loss, which we don't want to take. If you start taking maximum losses, you can lose on one trade what's going to take 4 months to be able to recover. Ideally, both legs expire in the money, and you end up walking away with a maximum return. So this is the primary trade that my trading partner and I put on. And I will tell you that for the first half of this year, we were successful on these trades 97.2% of the time. Average profit, we were running about 1% a day. And we never let this trade expire in between the two strikes. If that happens, then your short option expires worthless, and the long option, you automatically get exercised. So all these things that we've sort of talked about, right? All as you put these trades together, now you're starting to realize why I made such a big deal out of this stuff. Such a big deal out of what happens if you have an option expire in the money. As you start building your strategies, all of these things become applicable. Now, yeah, it's a lot to remember, but as you review things, and especially if we're going to continue working together, over time, they become second nature. They really do. So don't be intimidated. So now the fun part. Let's go show you how to put one of these together. What do I want to use? I'm going to start with Intel, because Intel has just been a crappy stock. I'm going to show you how to make money on it. Right now, I think you guys will get a kick out of this. So my wife knows I'm teaching a class, right? So she sends me a text message. Now, if she's going to send me a text message, knowing I'm teaching a class, it's got to be important. It's comforters. And we've only been in this house 6 weeks, bless her heart. All right, back to this, if I may. So I'm going to do a call spread. So the first thing that I want to do, I'm going to pick a different stock only because there's no room down at the bottom of this chart to illustrate. So it'd be fine for me, but it would be confusing for you. So I don't want to do that. Let me see. Another call spread. Pfizer. Where it gets easy is when I can do an illustration, where I can draw and stuff. Okay. So the first thing that I will do if I'm considering a call spread on something, it's because I've identified a good level of support. So let's draw that level. Okay. So it's right there. So we'd be betting that the price of Pfizer, if we do this trade, will not fall below, that's 83.30, will not fall below 80, or excuse me, the stock's at 29.42, support is at 28.30. So let's put this on where we're making a bet that the stock's not going to go below $28 a share. So that's the level. And I'm going to color code this to make it even easier. So red, that's going to be the short level. So let's pause here for a second. As long as Pfizer at expiration is above that red line, then that's the short strike of 28. We make a maximum profit. And then I'm going to let me paint a green line for the long option. Okay. So we'll probably be at 27. There we go. So we're betting that the price of the stock between now and expiration doesn't fall below 28. And we're covered with a long option at 27. So I'm going to show you what the trade looks like, tell you what the probability is of that trade being profitable, and what our max risk and projected profit is. Okay. So first of all, that part you need to understand. All right. So the stock's at 29.42. We're making a bet that it won't finish below 28. We all good with that? So stock could go down $1.42 and we'd still be fine. So I'm going to go into options. Let's say we're going to go out 27 days. So at 27 days, I'm hoping for a profit of around 27%. So it's two-legged trade. We're shorting the 28. So I'll just put a -1. Now, at the 28, I'm going to look at the delta. If you remember, I told you delta tells us the probability of the option finishing in the money at expiration. We want the option to finish in the money. So the delta is at 0.76. There is a 76% chance this option will finish in the money at expiration. Most all the credit spreads that I put on have a delta between 70 and 80. Right? That's the sweet spot. So I've shorted the 28. I'm going to go long the 27. I'm going to hit the trade button. I'm going to go to the mid. So now I can see, let's see. So to get into this trade would cost 87 cents. What's my max profit? The difference between the two spreads, which is $1, minus 87. My max profit is 13 cents a share. By the way, this trade would only cost $87 a contract. You could do 10 contracts for 870 bucks. So if I take a max profit of 13 cents, divide it by my risk of 87 cents, that is a return of 15%. That's too light. I would want, with a delta of 76, I want to return closer to 20% for 27 days. So I wouldn't actually put this trade on, but it's not a horrible trade. There's a 76% probability that I'd make 15% in 27 days. And some of you might be thinking, hell, I'd be happy if I made 15% in a year. So if you want to take a picture of that trade, feel free. One of you wanted a picture of the trades that I had in the virtual account. Do it fast. Take a picture of that quick. So there's one. Let me go shop for another. FedEx. All right, let's look at the chart. So I'm gonna just repeat what I had done. I am looking for a level of support. Now, if you get too far away, where did that close? 285. Oh, never mind. FedEx. Now I remember the story. Let me refresh all of your memory. Hopefully your memory is better than mine. Remember FedEx had that big drop after earnings? And I said, yeah, but I would expect it to continue to stay above this level. So there's your support. That would be at 248. So I might go down to like 245. Now I'm going to tell you in advance, at 245, we may be too far away from the current price of the stock to make much money. It'd be a very high probability trade, but the only way that I'll know is to look. So let's go into options. Let's do the same 27 days. That'd be the third Friday. If I short the 245, they don't have a 245. So I can either pick a 250 or a 240. I would pick the 240. Now, the probability is about 80%. This is a very low risk trade. So in this case, if I could make 15%, I'd be good with it. I don't know that I can, though. Probably going to be closer to 10%. So if I short the 240 and I buy the 230, let's come over here to the trade. And I'm going to go to the mid. Okay. So at $8.85 a share, that's $885 per contract. FedEx is $254 stock. Let me put a trade on it for less than $1,000. So what is my potential return? The difference between the two strikes, $10, minus the cost to get in, $8.85. So $1.15. Divide that by 885. That's a return of 13% with an 80% probability on what I would consider to be a super conservative trade to make 13% on this in 27 days, where I'm betting that the price of the stock won't go below 240, which is down there. It hadn't been below 240 in a long time. That's a trade I would definitely consider taking. Let's do another one. That's how you learn. That's why I kept track of these for you. Waste management. Okay, same deal. Where do I think the price of this stock is not going to fall below? I don't think we're going to get much for it. So down here, that's 196. So I'd be looking at 195. 195 will take us to here, right down here. Right? So you see what I'm doing? I'm picking a place where I go, I don't think it's going to fall below that level. Why do I not think it's going to fall below that level? Because it hasn't fallen below that level, right? I see that when it got down here, it bounced. And it's kind of moving sideways now. This will be another high probability trade. So let's do the same 27 days. And we're going to look at 195, delta of 0.77. And I'm going to buy the 190. Okay. The mid, yeah, it's a great trade. Problem is, you're not going to get anything. They're only going to pay you a quarter. So 25 cents divided by 475 is a return of 5.2%, 27 days. I wouldn't get out of bed for 5.2%, so I would just scratch that one off my list. Everything is about, upside versus risk. We had another one, OKE. So when I find candidates, what I'm doing right now is exactly what I do. I'm looking at them on a chart. And then I go into the options chain. Now, this one, it doesn't have weeklies, which would be okay for this. But where's my level? It's at 90. Stock's at 93.97. So my short would be at 90. So I'm going to go into options. I'm going to do same expiration, 27 days out. Here's the 90. Delta 75, great, right in the sweet spot. And we're going to go 87.50 as the long. So now the difference in the strikes is only 250. Let's see what we could get into this trade for. 215. This one might actually be kind of interesting. So if the difference is 250, we're paying 215. Our max profit is 35 cents. Divide it by 215. So you're into this trade for $215 a contract. That's a return of 16.2% in 27 days. Probability, 76%. Did I have any others? I think that was all that I had. Now I'll go back to Intel, and it'll be our last one. Okay. So with Intel, we've got support down here at 20. So again, what am I going to do? I'm going to short a 20, strike, call. This will be a very inexpensive. Delta is 73. Great. So I'm shorting a 20. I'm going long the 19. So the spread is $1. We can get into this trade for $1.09. So what does that mean? We can't make any money. So we don't take that trade. So those are all of my potential spread trades. So again, the whole idea is we identify a level of support. That's where we go short. Generally, we'll do the next strike below it to go long. And then once you're into these trades, the whole idea is like this one, right? So we did 90. The whole idea is we've got to watch this stock. And if it gets down to that short, we're going to close it out. Hopefully, if that doesn't happen, we just let both of those options expire worthless. Actually, I'm sorry. We let both of those options expire in the money and we make a maximum profit. And I typically have 4 or 5 of those trades on at all times. High probability, nice rates of return. And this year that has yielded for us on average about 1% per day. That will take a while to master. The best way to learn it are to put sample trades like what I've just given you into a virtual account and watch what happens to the price of the underlying, that stock, and then see how it impacts the value of the spread trades. Something else sort of nuanced about spread trades, which is this. Because you're both going long and short simultaneously, most all the profit on these trades typically gets made in the last week. Every now and then I'll put on a spread trade and the stock will scream up and I can close it out early, right? And as long as I can capture most all the profit, to close it out, free that money up to go somewhere else is fine. But that's kind of one of the nuances. It's going to take some experience. Other times I will be in a spread trade and I could make adjustments. In other words, the stock has come down maybe to that 105 and then I drop the 2 strike prices. Maybe I go from 105, 100 to 195. All of that will happen down the road. It's not going to happen on Monday. Some of the things we've talked about are fairly straightforward and simple. Some are more complex. Now, I want you to know something that I'm going to do for all of you. I'm going to, because when we get done here in 10 minutes, Lori's going to take over for a while. But as you process and look at notes and review, you're going to come up with a whole list of, oh, I wish I would have asked that, or I wish, they would have addressed that, whatever it is. I'm going to come back on Wednesday and I'm going to do a follow-up Q&A with you. So if there's anything out there still lingering, don't fret about it. You're going to get an invitation. Lori will talk to you about it. It'll be emailed to you and so forth. So you're not done with me yet. I've really enjoyed being with all of you, and we're going to circle back. So what I'm going to do now, for lack of a better term, I'm going to show off for a minute. And I'm not showing off me. Again, I'm going to try to paint a picture of where I want you to ultimately get in your trading career. For you to get to this place, I'm going to show you, you're going to have to be truly committed, put in the time and put in the work. But I want to show you kind of from beginning to end, just sort of the way that a trade can evolve. So basically, here are the steps. Step one, you have to identify opportunities. Where do we find opportunities? On the charts. Step two, got to put a plan together. So most people start thinking, okay, if I think a stock's going to go up, I buy a call, go down, I buy a put. And now we're learning, wait a second, there's a lot of stuff we can do. You know, if we're bullish, we could buy the stock, we could do a covered call, we could buy it in the money call, we could buy an out of the money call. Now I got this call spread. I could do a leap on, I could do a leap and sell short calls against it. This is where the skill comes in. Then here's the easy part, executing the trade. That's just learning the platform. Literally, to put on a trade, you watched me do 15 of them. How long did it take? Less than a minute. That part I could teach a junior high kid. Then once you're in these trades, you got to monitor them. You got to keep an eye on them, right? What is the underlying doing? And on the trades that you're in every day, I'd like you to look at what the underlying stock is doing and how it's impacting the value of the option. It shows up in your account. And then ultimately learning how to adjust and properly close trades. So trade management. I want to give you a real world example of a trade that went wrong. How's that? And I want to show you what we did. So I'm looking at a chart. This is some years ago. And what do I see? Kind of a double top, big red candle, and everything had just turned bearish. So guess what we're going to do? We're going to buy a put option. So price of the stock was 39. I bought a 37 strike put out of the money. And then that happened. So I want to paint a picture. You have three investors, three traders. We have an amateur, somebody who's, call them an intermediate, and then we've got me in this example. So you're in a put option and that happens. What do you do? If you're an amateur, you probably don't do anything. You go, oh, crap, I hope that stock turns around and goes back down. If you're an intermediate, you go, well, I'm no longer bearish, so I'll just close the trade out and take my lumps. And the lumps here would have been about a 50% loss. What did I do? I looked at that and said, okay, well, I still have that double top. So to recover from what I lost on this long put, I'm going to short a 39 strike put. The money that I collect there will offset, what I've lost on the long put. And as long as the stock stays above $39 a share, I will manage to break even. And there are times when turning a loser into a break even is a great victory. And then this happened. So now I've broken above the double top. I am now what? Bullish, right? So I bought a call option. So I'm in good shape on those puts. They're going to both expire and I'll break even on those. Here, I'm riding this call option up, and then that happened. And then with the big red candle, I closed out at a profit of 150%. So you have three traders who put on the same trade. One loses 100%, one loses 50%, one makes 150%. We all started with this same trade. What's the difference? One of us knew more than the others. So I guess the question that I have for you when it comes to options, how much do you want to know? You want to know some of it? Do you want to know all of it? And that's up to the individual. You know, I have this really weird personality, which is if I'm going to do something, I want to get absolutely everything that I can out of it. You know, a month ago, it was 100 degrees where I am. One of the big challenges personally in my life right now, this is when you know your life is good, because, you know, no, I'm not fighting a disease, is I want to be better at skiing. It's 100 degrees and I'm watching videotapes on skiing. On Monday, because there's no snow yet, I'm going to an indoor trainer with a simulator to go pretend I'm skiing. If I'm going to do something, I want to get everything I can out of it. And that's just me. You don't have to be like me, but you are going to need to make a decision. You know, how much do you want to know about options and what is the fastest way to get you there? So putting it all together, becoming a successful trader, first, got to educate yourself. And the education will never end. That I can promise you from experience. Consider your resources. You know, some of you are sitting there going, well, I just don't have much. Well, maybe you need to go sell some crap. Maybe there are things you don't use anymore. You could put on eBay and now they're gone. And now you've got some cash to be able to put into your account. Maybe as you look at how you spend money, there are things you don't need. You don't need Starbucks. You want Starbucks. Two different things, right? So the only thing you need is food, clothing, and shelter. Everything else is optional. So what can you reduce? Again, with the idea of, and the way that I look at a dollar, I look at a dollar and I say, in 2 years, you're going to be $2. So it helps you to make better financial decisions. Got to set up your trading account if you don't have one. Use asset allocation, no more than 10% in any one trade. Do practice trades. They don't cost you anything. And if you screw up with virtual money, not real money. Then start executing live trades. Start small, you know, 1 or 2 contracts. That's it. And then learn how to adjust and close trades. And then you can start to scale up. And then the last thing, find a mentor. If it's not us, that's okay. You know what a mentor will do for you? They will save you mistakes, losses, and most importantly, time. We love to apply for the position. That's why we set up our mastermind that we talked about. Some of you, I think, have already enrolled. And if you have, good on you. I'm glad that you saw the value and all of that stuff. For those of you that maybe weren't here yesterday,